It was a Friday. Precisely 10th March 2023 when police officers arrived at Silicon Valley Bank's headquarters in Santa Clara, California. The U.S. authorities swooped in and seized the assets of Silicon Valley Bank, a key lender to U.S. startups since the 1980s, after a run on deposits made it no longer possible for the bank to run on its own. In other words, Silicon Valley Bank has collapsed. It happened in a very spectacular fashion only a few days after the bank announced big losses, failing at attempts to raise funds or secure a buyer, and creating the biggest bank failure in the United States since the Great Recession. For the first time since Inception, the Silicon Valley Bank made world news for a negative occurrence.
A rough week for the banking industry.
The collapse of Silicon Valley Bank.
The second biggest bank collapse in U.S. history.
Again, it wasn't just news, history was rewritten. The fall of Silicon Valley Bank is the second largest bank failure in U.S. history. Only 2 days before the collapse happened, the bank raised an alarm, stating that it was facing a cash crunch. As a result, it tried to raise money by selling shares. When that didn't work out, it tried to sell itself. The situation wouldn't have amounted to such a crisis except that, instead of receiving help and sympathy, investors got agitated and resolved to withdraw their support. Ultimately, the bank went under. However, this wasn't a surprise to analysts, seeing that the announcement was enough to send shock waves across the tech sector. It happened that after learning of the cash crunch the bank was facing, companies and people with money in Silicon Valley began to get their money out, an action that contributed to the bank's demise. But presumably not everyone was able to get their cash out, as the FDIC only insures deposits up to $250,000. Beyond tech, this has caused an uproar across the banking industry, especially with concerns that other banks could be in trouble or that contagion could set in. The Silicon Valley crisis has proven to be a big deal and a symptom of bigger forces in motion in tech, finance, and the economy, stirring fear in the minds of people. After all said, you might still be wondering what really happened. Silicon Valley Bank met its demise largely as the result of a good old-fashioned bank run after signs of trouble began to emerge earlier that week. What happens is the bank takes deposits from clients and invests them in generally safe securities, like bonds. As the Federal Reserve increased interest rates, those bonds began to be worth less. Normally, that wouldn't be an issue. Silicon Valley Bank would just wait for those bonds to mature. But this time something else was amiss. There had been a slowdown in venture capital and tech more broadly, deposit inflows slowed, and clients started withdrawing their money. These all took a negative turn in the finances. On the 8th of March, Silicon Valley Bank's parent company, SVB Financial Group, said it would undertake a $2.25 billion share sale after selling $21 billion of securities from its portfolio at a nearly $2 billion loss. The move, which was meant to shore up its balance sheet, caused an alarm instead. The next day, the share prices plunged, and the day after that, trading of the stock was suddenly stopped with reports following that Silicon Valley Bank was out for sale. Out of fear, big-name venture capitalists like Peter Thiel and Union Square Ventures started pulling their money out of the bank while they could. People started freaking out, aggressively getting their money out of the bank. And unfortunately, it was justifiable. By midday, the bank was shut down by the regulators. The whole world agrees that this happened just too fast. Well, a major cause of this is the fact that Silicon Valley Bank was too concentrated in its business. The bank catered to venture capital and private equity, a sector that has done well over the past decade. But because the bank was also very concentrated with high exposure to just one industry, which opened it up to risks such that when things got bad for its non-diversified group of clients, it very quickly got bad for the bank. This just proves that having over 50% of your business in one industry is very dangerous. The pressure got even worse when another bank, Silvergate, which catered to crypto, said it was winding down that very week. It seemed as though everything froze and everyone freaked out immediately. The trouble with Silicon Valley Bank began. This is not a slow fall from grace here, this is quick, an analyst said. The Silicon Valley Bank was one of the largest banks in the US, and it went down in only 2 days. Now, what does this mean for the banking system, and just how worried should we get? A school of thought claims that it is good for banks to fail from time to time. In fact, the longest stretch in US history without a bank failure was from 2004 to 2007, and well, you know what happened after that. The largest banking failure in history. The truth is, at the moment, the banking industry is doing pretty well. Also, Silicon Valley Bank would probably have made it through had everybody not freaked out at the same time. According to Aaron Klein, a senior economist, there is always a risk of contagion, because banking is fundamentally a game of trust and confidence. When they erode, the system becomes less stable. This, we have seen play out. It wouldn't be a surprise if a couple of other banks run into trouble after this because customers are afraid of a recurrence of the bank crisis. Yet, if this happens, there are some banks that would not partake in the fall. Banks like JP Morgan, Wells Fargo, and Bank of America, who are diversified and have a ton of deposits. Even if these particular banks lose some investments, they won't still go under. In fact, they won't be close to the line of having to sell securities. It is quite unfortunate that tech companies are the main victims of this crisis. The most pressing issue for these tech companies that had money tied up with Silicon Valley Bank and haven't gotten it out yet is a very big question that doesn't have obvious answers. What happens to unpaid employees? While the FDIC will guarantee deposits of up to $250,000, depending on the size of the company, that money may not be enough. This doesn't just apply to companies that deposited cash with the bank. It's also a question for companies using other SVB instruments, like revolver loans or credit cards. Besides that, there are also serious concerns about knock-on effects. Because even if a particular startup doesn't bank with Silicon Valley, its vendors might, so they may not be able to provide the startup with services it expects and counts on. Even in the optimistic case, where SVB is quickly acquired by another bank and funds start flowing again, the near-term hiccups could be unpleasant for many people. Before the crisis, Silicon Valley Bank rightly positioned itself as the tech bank. One way to gauge its influence in the tech world was to attend a tech conference, where the bank was often a prominent sponsor. Unlike other banks, tech industry observers say Silicon Valley Bank was willing to work with tech startups in the most supportive ways, like helping early employees secure personal loans for a house. One major concern of the companies in business with Silicon Valley Bank is the reliability of the Federal Deposit Insurance Corporation. The FDIC was created in the wake of the Great Depression, when a lot of banks failed and their customers lost all of their money. It was created to protect customers of American banks and provide some stability to the American banking system. If a member bank fails, its deposits are still insured for not more than $250,000 per individual. A few days after Silicon Valley Bank's collapse, the Federal Reserve Board, Department of the Treasury, and the FDIC announced that it would make additional funding available to eligible depository institutions, which would repay depositors in full. According to the announcement, the said funding will come from loans from the newly created Bank Term Funding Program. Because this is so new, we don't yet know exactly how it will all work or when depositors can expect to get their money back. However, the FDIC had earlier announced that the $250,000 insured funds would be available the following week, and that it is still trying to figure out who exceeds that $250,000 mark and by how much. While it is tempting to start making assumptions and drawing conclusions concerning what will become of Silicon Valley Bank, it is better to wait for further announcements. Indeed, the news is shocking, but we can only hope unpleasantness ends there and customers' assets are secured. Subscribe to this channel to see the latest development and the impending fate of Silicon Valley customers. See you soon.